Hello and welcome to another episode of the Money Matters podcast. My name is PJ Patterson, and today's topic is how do you play inflation? Now, I'm specifically talking about inflation as a trade. So, for those of you who are actively managing, say, a superannuation account or personal investment account, something like that, the topic is really about how you get exposure to the inflation trade. So let me just delve into what that actually means. So during parts of the business cycle and economic cycle, we experience bouts of inflation. Now, inflation is broadly defined as the growth of the money supply, but where you see inflation actually show up is in the prices of things. So you see, for example, the price of petrol rising, you might see the price of food rising, the price of medical care, whatever, housing, all of these things are rising. And that's the result of inflating the money supply. Now, as I record this, it's 2021, and we've just been through the 2020 COVID period, and central banks around the world and governments around the world have provided epic amounts of stimulus into the market to try to rejuvenate and revive the economies, which tanked because of basically a worldwide global, same thing, global economic shutdown. And so all of this money that has been created and put out into the system eventually needs to find a home. And typically, what you begin to see is asset price inflation, and that shows up in the price of housing, it shows up in the price of commodities, it shows up in the price of a lot of things, food on the table, etc. So I just want to give you some tools, tips and tools on how to play this because a lot of investors do not know how to get the proper sort of exposure in their portfolios to inflation. And there's a couple of ways to do that. So one of the things one of the things that's a bit of misnomer about inflation is that gold is a good hedge against inflation. It actually isn't. Now, typically what happens with an inflation environment is the bond market will begin to price in the fact that inflation is going to be occurring. And the way the bond market does that is the price of bonds begins to fall. And I'm talking about all bonds. So, well, really specifically government debt. So the U.S. Treasuries, Australian government bonds, bunds in Germany, gilts in the UK, and the list goes on. All of these debt instruments will begin to decline in value, which effectively means the interest rate on those things are rising. So you'll start to see the interest rates on bond yields rising. And this is a sign that the bond market understands that inflation is on its way and has begun to price that in. And so one of the things, of course, you can do if you have the capacity to do this as a trader and as a manager of your money, if you can short sell or possibly buy an inverse ETF. But if you can short government bonds, then that is a great way to play the inflation trade because, of course, bonds are going to continue to decline in value and you'll make money being short them. I think I've done an episode, or there is an episode, I should say, I don't think I have. There is an episode on short selling if you want to get a little bit more insight into short selling. Just listen to that episode. But if you can't short sell in your account, for example, a superannuation account in Australia probably doesn't have the capacity to short sell. So you're going to have to use other instruments in order to get exposure to the inflation trade. Now, how do you do that? So usually in an inflationary environment, guess what does really well? Stocks, equities. So you'll typically see that show up in the growth portion of your portfolio. So big cap, high beta type stocks will do very, very well in an inflationary environment. But there's another thing that does really well in an inflationary environment. That's energy. And I'm talking oil, natural gas, even other plays like uranium and some of the other energy, solar and so forth, will typically do okay in inflation. But specifically, it shows up in the price of oil. And of course, many, many other commodities will show inflation. So corn and wheat and soybeans and cocoa will also show that. It'll also show up in base metals. So things like copper and zinc. Silver, for example, is an industrial metal. A lot of people think it's a currency. It does sometimes have that attribute, but for the most part, it's used in the industrial processes, and so it will respond to inflation. Gold is, as I mentioned earlier, on the other hand, is not so much inclined to do that because gold does not like rising interest rates, so it will typically sell off in that environment to a certain point anyway, and not be as much of a performer as say silver. So that would be the way to play it. Now, there are a number of ETFs that are listed on the US Stock Exchange. There's one or two on the Australian Stock Exchange that will give you exposure to these things. And so, obviously, you would seek those out and you would give your portfolio some exposure to that. But broadly, of course, if you're just an Australian only investor and all you have access to is the Australian share market, there's a number of things that you can buy, a number of ETFs that you can buy in Australia, listed in Australia only, that will give you that exposure to inflation. So, the final thing I'll say about this is it's something that you have to be mindful of as an investor. Inflation, and really it is the reflation of assets from a deflationary period. So let me just explain that for a second. And I'll use the example again of COVID. During 2020, we had a huge deflation because the global economy shut down. So everything deflated. And as the central bankers, as I mentioned earlier, began to print more money and try to get more money and stimulus out into the system, we began to see a reflation. And so inflation is really part of that story of the reflation. And so during a reflation, again, you want to see, you want to own rather things that are going to reflate faster than the rate of inflation is rising. And again, those are things like your commodities, stocks, industrials, things of that nature. Hopefully that's been useful to give you a bit of insight into how to play inflation. You certainly would not want to be sitting in cash during an inflationary period because unfortunately the value of cash goes down during inflations because you have your purchasing power eroded. And this is again why you need to have exposure to commodities and other things that will go up faster than the rate of inflation. Anyway, I hope that's been useful. As always, I wish you all the success with your investing. My name is PJ Patterson. Thanks for joining us on the Money Matters podcast.